Hello, everyone. Thanks so much for being here today. We are here to address the most frequently asked questions we receive from investors here at BAM Capital. I am Catherine Herron, Vice President of Investor Relations, here with Tony Landa, Chief Investment Officer, and Ben Cotton, Vice President of Investor Relations. So to get us started, we will move to Tony Landa, who will talk to us about one of the most frequently asked questions we receive, which is what is BAM's position on interest rates, cap rates, and overall debt strategy?
Yeah, that's a great question. We get it often. BAM Capital has a healthy balance of floating rate debt and fixed rate debt, probably more floating than fixed. The single most important reason why we have floating rate debt is because we want prepayment flexibility. So we have the option to either refinance our loan at the end of year 3 after we've executed our business plan, or sell depending on market conditions. We're buying institutional quality apartment communities, and our intent is to add significant value in 2 to 3 years for our investors. Cap rates definitely going up, but more so in other markets than in the Midwest. In the Midwest, our fundamentals are really strong here. We have a healthy supply-demand imbalance. It's very affordable. So we're seeing tremendous NOI growth in our Fund 1, Fund 2, Fund 3, and some of our single assets. Our lease tradeouts are double digits, so we're seeing really good rent growth. And what that does, that helps offset the pain of rising interest rates. And CBRE just came out with a survey, a national recent cap rate survey, and I was shocked because the survey dictated that or indicated that cap rates are still sub 5% from a national perspective. And what I felt most interesting was that the exit cap rates, which are typically higher than your going in cap rate, those were still sub 5. So that speaks to the strength of the apartment market.
So, Tony, talk to us about what metrics we use when valuating the real estate. And then commercial versus multifamily market overall. Arguably, there's been a bit of bad press on commercial. So what are those key differences and differentiators between commercial and multifamily?
Yep, great question. We get that question all the time, cap rates versus interest rates. So investor comes to us, says, you're buying at a 5 cap, but you're borrowing at a 7% money. What we call that in the industry is negative leverage, and it reduces your cash on cash yield to the tune of 1 to 2%. We don't typically, the better way to look at it for us, and what really is the secret to our success, is looking at the stabilized yield on cost. So let me explain that with a math example. Let's say we buy a beautiful, gorgeous asset here in Indianapolis for $100 million. We put on a $70 million loan, coming to the table with $30 million. NOI on this deal before debt is $5 million. Well, that's a 5% cap rate. Well, we're looking at institutional quality real estate, like I said, where we can add a ton of value. So we're looking to take that $5 million of NOI to $7.5 million of NOI. And so if I think I can get out of that deal at a 5 cap to a 5.5 cap, that's north of $140 million on our initial $140 million purchase. That alone will get me north of a 2 equity multiple and an upper teens return to our investors. The other question that we get a lot is multifamily versus commercial. Should they be lumped together? And so I've been in the industry for 30 years, and that's been the debate that whole time, and it'll continue to be the debate going forward. My opinion, I don't think multifamily should be lumped into commercial real estate. One of the biggest things about multifamily is it's extremely liquid. Not only do you have a number of buyers and investors out there when you go to sell the asset, there's a ton of lenders willing to lend on multifamily versus commercial. For example, multifamily, you can go to Freddie, Fannie, life insurance companies, CMBS lenders, HUD. There's no shortage of lenders for multifamily. Today, with commercial real estate, there's definitely a shortage of lenders out there, especially for value add type office buildings or retail centers. It's very hard to find a lender, and everything that's happening post pandemic with less people returning to the office and impacting the fundamentals makes it even more difficult. The other thing too are the leases that are in place. Apartment communities have shorter term leases, typically 12 months. That's not the case with commercial. You have longer term leases, 3 years, 5 years, 7 years, sometimes as high as 20 years. So you can't pivot quickly in an environment with rising costs. Multifamily, you can adjust your rents within a 12-month time frame, within 12 months on almost your entire, almost on every unit or every resident, and you can offset the pain and adjust those rates to offset the pain of rising costs. The other one too is fundamentals. I mentioned it a little bit earlier. Cap rates for multifamily are still sub 5. That speaks to the strength of the multifamily apartment community. Commercial, not so much. Office and retail, they could be as high as 300, 400 basis points higher than that on commercial real estate. So that's one thing. The other thing is the fundamentals too. Vacancy rates nationally for apartments still hover right around 5-6%. Office, it's hovering right around 19-20%, even worse in certain markets around the country. So fundamentals, valuation, liquidity, leases, all key differentiators to commercial real estate.
Absolutely. Thanks, Tony. And now that we've talked a bit about debt strategy, interest rates, and the markets overall, let's drill into the details of BAM Multifamily Growth and Income Fund 4. Ben, tell us about that.
That's a very common question. If you're an investor, you say, how do I get paid as an investor with BAM Capital? So we've split the fund into two distinct shares. You've got A shares and you have B shares. A share investors are investors that are concerned with current income and what could be considered a higher degree of safety because they do not share in the back end when we sell. So if you're an A share investor, if you invest more than $2 million with us, you get 11%. That's an annual return, and we pay that monthly. If it's less than that, down to $250,000, we pay 10%, and then anything under $250,000 is 9%. But those investors are paid monthly. We treat it like it's debt. We've never missed a payment to our A share investors. If you're a B share investor, that's geared towards investors who say, look, I'm not concerned with current income right now. I'd like the highest chance for the highest return. These are investors that if you invested in the last 12 exits, you would have gotten a 35.14% IRR. That's net of fees to investors. That's a 2.58x in 3.4 years. Now, look, full disclosure, the past doesn't dictate the future, but the people and the processes and our investment discipline haven't changed. So I think it's completely feasible for investors, B share investors, to see a 20% plus IRR, a 2+ X return in a 3 to 5 year period. But again, that's for investors that are not concerned about current income, who would like a maximum return and would like a share in some of the tax benefits that go along with that. One of the other questions we often get as a follow-up is, how many properties do you expect to be in the fund? So Fund 4, we're raising somewhere between $120 and $150 million, and that'll give us the opportunity to buy somewhere between 4 and 6 properties. And then the question we get right after how many properties is how long do you think the fund will last? And while nobody has a crystal ball and we can't tell you indefinitely, here's what typically happens. If the fund has 6 properties, it's likely that 3 of those properties will transact, either refinance, give money back to investors plus a return, or sell in that 3 to 5 year period. You'll have 1 or 2 properties that maybe take a little bit longer. And you may have 1 or 2 properties that, we've done a great job. It took us less time than we thought to increase the NOI, and it may be less time. But net, you should have a majority of your investment dollars back to you, plus a healthy return in that 4 or 5 year period.
So the other question that we get most frequently is, how do we get started? And I'd be happy to answer that. So once you're ready to invest, let your account lead know the amount that you intend to invest and how you want to title your investment, whether that be through a trust or individually, jointly with a spouse, through a self-directed IRA account. You can initiate the documents process from your end on the portal, or we can send you a link to sign your subscription documents. In parallel with that, you will work with your CPA or attorney to have them confirm that you are an accredited investor. We are required by the SEC. All of our investors must be accredited, and we do have to have documentation that confirms that. But we have a template letter that you can send to your CPA or attorney for them to sign. And if you don't have a CPA or attorney, no problem. Just let us know, and we can refer you out to a third party. And then once you've signed your subscription documents and provided your accreditation letter, within a few days, you'll receive your capital call notice. That capital call notice will contain your wire instructions and everything that you need to know in order to facilitate transmission of funds. It's important to note that we do call capital on the full amount of your subscription, which means that your capital is put to work all at one time and within a few weeks of funding at most. That capital call notice will be posted to your investor portal, and you'll also get an email notification. So in short, sign your subscription documents, provide an accreditation letter, and fund your investment. So those are the most frequently asked questions we get here at BAM Capital. We have done our best to answer those as concisely but as thoroughly as possible for you. So if you have any questions, please reach out to us. Our contact information is available at the bottom of the screen. We are here to support you and look forward to stewarding your hard-earned capital. Thanks so much, everyone.
Thanks, Catherine. Thank you, Ben.
Yeah,
Thanks,
thank you,
guys.
Catherine. Thank you, Tony.
Likewise. Thanks so much. Bye.